Welcome to Tech Money Madness, your daily U.S. stock market podcast. July 16th, 2026.
Glad to be here for today's market action.
Yeah, and I want you to imagine sitting in traffic, right? In a car that's basically running out of gas.
Oh, a nightmare scenario.
Right, you're stressed, the dashboard lights are flashing, the engine is visibly sputtering, but then you look out the window, and right next to the highway, someone is building a multi-billion-dollar luxury skyscraper at absolute record speed.
Just completely ignoring the traffic jam.
Exactly, completely ignoring it. And if you really want to understand the global economy right now, that is the exact dynamic playing out today.
It really is. It's a massive structural divergence.
Yeah, we have this broader macro environment that is just visibly slowing down, and it's colliding with these tech mega corporations that are, well, they're absorbing capital like black holes.
Yeah, the traditional markers we use to measure economic health, they're flashing yellow, or, honestly, even red in some parts of the world right now. Yet the micro maneuvers of these specific mega cap companies, they suggest they're operating in an entirely different financial reality.
It's wild. Well, our mission for today's deep dive is to pull from the daily market briefing to figure out exactly how this is happening.
We've got a lot to get through.
We do. We're looking at a stack of sources covering the latest inflation and job data, some frankly jaw-dropping returns from institutional funds, and a series of strategic supply chain deals that are literally shifting the balance of power in big tech.
It's a packed briefing today.
It really is. Okay, let's unpack this. And I want to start with the macroeconomic picture.
Good place to start.
Because, if we are going to understand where all this money is flowing, we really have to understand the turbulent waters it's navigating through first.
Right, the environment itself.
Exactly. And looking at the U.S. data from the briefing, things just feel highly contradictory.
Oh, contradictory is the perfect word. The signals are actively fighting each other right now.
Yeah. For instance, wholesale prices, they unexpectedly dropped 0.3% in June.
Which you'd think is great news.
Right, and the sources attribute that mostly to easing energy costs.
Yeah.
But at the exact same time, consumer prices rose 3.5% annually.
Yeah.
Which, granted, that was less than expected, but it still means the end consumer is feeling the pinch even while the producers are seeing their energy bills drop.
Exactly. That relief isn't making it to the checkout aisle.
No, it's not. And then there is the labor market. Job creation essentially just hit a wall.
It stalled out completely.
We only saw 57,000 new payrolls added. That pushed unemployment up to 4.2%.
And that 57,000 number, that is the flashing yellow light on the dashboard you mentioned earlier.
Because it's so low.
Right. When you drop below the replacement rate for population growth, which is roughly where that number sits, you're looking at a labor market that is actively cooling.
Employers are just pulling back.
Exactly. They're tapping the brakes.
But, the detail that really cemented this for me, it came from the Fed's Beige book.
Oh, the World Cup data.
Yes. The U.S. just hosted the World Cup. This is one of the largest global events in human history.
Millions of people.
Millions of people, literally billions of dollars moving across borders. And the Fed explicitly noted that the World Cup completely failed to translate into broader economic growth for the U.S.
Which is pretty shocking when you think about it.
It is. My immediate theory reading that was simply that the consumer is just exhausted. They might stretch their budget to buy a match ticket, but they're entirely skipping the hotel dinner, or the merchandise.
Yeah, it points to this profound lack of elasticity in consumer wallets right now.
What do you mean by that?
Well, usually a mega event like the World Cup acts as an economic multiplier.
Okay.
So $1 spent on a stadium ticket becomes $1 spent at a local restaurant, which then becomes $1 spent on local services, and so on.
Right, circulates.
Exactly. But if that multiplier effect is broken, it means consumers are ruthlessly compartmentalizing their spending.
Like, I can afford this one thing and literally nothing else. So if the U.S. economy is that car taking its foot off the gas, slowing down on jobs, seeing consumers tap out, but kind of still coasting on momentum, I would expect the rest of the world to be in a similar boat.
You would think so, yeah.
But looking at the international data, it's not synchronized at all. It's entirely fragmented.
Completely fractured.
China just posted its slowest quarterly growth since 2022. Their internal investment is slumping so heavily that there are widespread calls for massive government stimulus.
Just to keep the floor from falling out over there.
Right.
Which, by the way, is a classic deflationary environment. They are actively struggling to generate domestic demand.
But then you cross the Himalayas into India, and you see the exact opposite problem.
Exact opposite.
I was just going to bring up India, actually. Their inflation just accelerated to 4.38%, which completely beat forecasts.
Spiking hard.
Yeah, and that's being driven by massive spikes in food and energy prices. Meanwhile, over in Europe, the European Central Bank is basically paralyzed.
Yeah, they're in a tough spot.
The briefing notes their interest rate decision is completely in limbo because of renewed hostilities in the Strait of Hormuz. And I have to admit, I'm a little confused by the mechanics here.
How so?
Well, if energy prices dropped enough in the U.S. to drag down our wholesale prices, why is the ECB terrified by shipping lanes in Hormuz? And why is India seeing energy spikes? I mean, are we not operating in a globalized energy market anymore?
We are, definitely. But what's fascinating here is that the shock absorbers are distributed so unevenly.
Okay, unpack that.
So the U.S. has massive domestic energy production. When global prices fluctuate, the U.S. has this internal buffer that absorbs a lot of that volatility before it ever hits the wholesale level.
Oh, I see. We produce so much ourselves that we're insulated.
Exactly. Europe and India do not have that luxury.
Yeah.
Europe in particular is deeply reliant on those specific shipping lanes through the Middle East for liquefied natural gas and oil.
Right.
So if hostilities threaten Hormuz, the risk premium on European energy just spikes immediately. They feel it instantly.
So for you listening, trying to budget your life or maybe manage your portfolio, the takeaway here is that the era of central banks holding hands and jumping together, that's over.
That is the crucial insight. For the last 2 decades, the Fed, the ECB, the Asian central banks, they largely moved in unison.
Right. If there was a crisis, they all cut rates.
Yep. If there was inflation, they all hiked. But now
it's every bank for itself.
pretty much. The Fed is staring at a cooling job market, China is begging for stimulus, and India is fighting overheating prices. Central banks are playing completely different sheet music right now.
And that creates a highly unpredictable, choppy environment for global capital, which actually makes the second section of our briefing so bizarre.
Oh, the tech valuation.
Yes, because in a choppy, unpredictable environment where central banks are out of sync, traditional financial logic dictates flight to safety, right?
Usually bonds, gold, maybe defensive consumer staples.
Exactly. You certainly wouldn't expect investors to throw billions of dollars at the most expensive companies in the world.
No, you wouldn't.
Yet we are seeing this massive valuation paradox with the Magnificent Seven tech stocks.
It completely upends traditional risk models.
It really does. The sources specifically highlight Apple, Alphabet, and Amazon. Despite this global macro mess we just talked about, these specific stocks are the top gainers and the most active stocks in the market right now.
Which is incredible momentum.
But here's the paradox.
Yeah.
The briefing states they are currently trading at their lowest relative valuations in a decade.
Keyword there being relative.
Right, because I'll be honest, when I read lowest valuation, my brain immediately pictures a discount bin.
Sure.
But their actual stock prices are near record highs. So I need to formulate a hypothesis here, and you tell me if I'm off base.
Let's hear it.
Are we looking at a situation where the stock price is high, but the underlying machinery of the company has grown so incredibly fast that the price tag is actually lagging behind the reality of their dominance?
Your hypothesis is spot on. That's exactly it.
Okay, good.
To understand relative valuation, think of it like buying a manufacturing plant. Let's say 10 years ago, a plant cost $10 million and it produced 1 million widgets a year.
Okay, 10 million for a million widgets.
Right. Today, that same plant might cost $50 million. On paper, it looks 5 times more expensive.
Huge price tag.
But if that plant underwent a massive technological upgrade and is now producing 50 million widgets a year.
Oh, I see.
Yeah, relatively speaking, you are paying less per widget than you were a decade ago.
So the actual efficiency of the profit engine is outpacing the premium of the stock price.
Exactly. Apple, Alphabet, and Amazon has scaled their earnings, their cash flows, their entire market capture to such an extreme degree that even at these high share prices, they are fundamentally cheaper relative to the cash they generate than they were in 2016.
That is wild. And, the institutional money is clearly doing that exact same math.
Oh, they absolutely are.
The Adams Diversified Equity Fund just reported a 10.8% total return on net asset value for the first half of 2026.
That's a massive return for a 6-month period.
It is. And for anyone unfamiliar, net asset value, or NAV, is basically the per-share value of all the underlying assets the fund holds. So a 10.8% return on NAV means the actual fundamental machinery they own is generating huge value.
Totally crushing the Morningstar U.S. large blend category, by the way.
Yeah, crushing it. And they aren't the only ones heavily allocated here. The briefing notes that Groq AI, who is Warren Buffett's successor at Berkshire Hathaway, he has parked 30% of Berkshire's entire portfolio into just 2 stocks.
Apple and Alphabet.
Apple and Alphabet, just those 2.
We really need to contextualize what 30% means for Berkshire Hathaway.
Please do, because it sounds crazy.
We are talking about hundreds of billions of dollars. Warren Buffett's entire philosophy, his legacy, was built on diversification across railroads, insurance, consumer goods, the physical economy.
Right, tangible stuff.
So for his successor to concentrate a third of that immense war chest into 2 tech platforms, I mean, it tells you everything you need to know about how smart money views that macro fragmentation we just discussed.
They aren't looking at Apple and Alphabet as risky tech bets anymore.
Not at all.
They are treating them as sovereign utility companies. They look at China slumping, Europe paralyzed by Hormuz, U.S. jobs cooling, and they just decide the safest place to hide money is inside the companies that own the digital infrastructure of daily life.
That's exactly the calculation.
Interestingly, though, not all tech is benefiting. NVIDIA, Meta, and Microsoft are listed in the briefing as the top losers today, which tells me this isn't just a blind tech bubble.
No, it is entirely selective. Investors are differentiating between companies that sell services to other businesses and companies that own the consumer outright.
And that distinction brings us right into the third part of the briefing, which is this specific battle for the crown of the world's most valuable company.
The heavyweight match.
Truly. Apple is currently predicted to surpass NVIDIA's staggering $5 trillion market cap.
$5 trillion. It's almost hard to comprehend.
It's insane. Their stock is rallying sharply ahead of their Q3 earnings. And the briefing attributes this to 3 things: optimism around their AI strategy, the sheer strength of their ecosystem, and a notable surge in iPhone sales growth in China.
Which is a very interesting data point.
Yeah, hold on, because that contradicts our earlier point.
Right.
We just established China is suffering its worst economic slump since 2022. So how is Apple growing iPhone sales in a slumping economy?
Because the nature of the smartphone has transitioned. It went from being a luxury good to vital infrastructure.
Really? Even in a severe downturn?
Especially in a downturn. Look, in a severe economic slump, a consumer will cancel their vacation, they'll hold off on buying a car, and they'll definitely stop eating out.
Sure.
But they will still buy the phone because it is the central node for their banking, their communication, and their work. In a fragmented economy, the phone is the ultimate necessity.
Right. Okay, that makes sense. But the piece of the Apple strategy that really fascinated me isn't the phone itself.
What stood out to you?
It's how they're building it. Because Broadcom just committed to a massive $30 billion deal with Apple for chip production. And this deal runs all the way through 2031.
Half a decade.
Yeah. The briefing frames this as a mutual win, right? Broadcom gets half a decade of guaranteed revenue, reducing their customer concentration risk, and Apple secures its vital supply chain.
Win-win.
Here's where it gets really interesting, though. My initial read on this was to view it like a massive corporate prenup-locking instability. But considering the scale of the AI arms race, is there a more aggressive angle here?
Oh, absolutely.
Like, is Apple locking up this supply chain just to starve their competitors of the actual physical capacity to build hardware?
Yes. It's much more aggressive than a prenup. A prenup implies protecting what you already have, right?
Right.
What's fascinating here is that this is a blockade. You have to understand that global fab capacity, the actual physical facilities that manufacture these highly complex RF components and wireless chips, it is strictly finite.
You can't just wish a factory into existence.
Exactly. You can't just spin up a new microchip factory overnight. It takes years, and it takes billions of dollars. So by committing $30 billion through 2031, Apple is basically buying up space on the manufacturing line.
So if a competitor, whoever it is, wants to build a rival device with the same capabilities, Broadcom essentially has to tell them, sorry, this assembly line belongs to Apple until the next decade.
Precisely. And this highlights the structural difference between Apple and a company like NVIDIA.
Okay, break that down.
So NVIDIA has been the darling of the market because they make the raw AI chips. They're making the shovels for the gold rush.
And everyone needs shovels.
Right. But NVIDIA is vulnerable to corporate budgets. If Microsoft or Meta, who again are on the losers list today, if they decide their AI features aren't generating enough ad revenue, they might cut their capital expenditure.
And if they cut their budget, they stop buying from NVIDIA.
Exactly. NVIDIA's revenue takes a massive hit.
So NVIDIA sells the engine, but Apple is trying to own the entire highway system.
That's a great way to put it.
By locking down the hardware supply with Broadcom, Apple ensures that no matter how chaotic the geopolitical landscape gets in, say, Taiwan or the Middle East, they have the physical components to put AI directly into a billion consumers' pockets.
It's the ultimate moat. A secured hardware supply chain immunizes Apple from the global fragmentation we discussed in Section 1. They are insulating themselves from the macro chaos.
And what they plan to do with that insulated hardware moat brings us to the final and, frankly, the most consequential section of our briefing today.
This is the big one.
Yeah, because you don't sink $30 billion into a 5-year chip blockade just to sell a slightly faster version of Siri.
No, you definitely don't.
You do it because you want to capture something much, much bigger. Apple is securing a hardware because they want to secure the transactions flowing through that hardware.
It's the transition from a communication device to financial infrastructure.
Exactly. The briefing projects the global mobile payment market is going to hit an absolute jaw-dropping $19.86 trillion by 2035.
Staggering.
Nearly $20 trillion. And the growth rate is phenomenal. It's a compound annual growth rate, or CAGR, of 18.80%.
And, for anyone doing the math at home, a CAGR of almost 19% means the entire market is basically doubling every 4 years.
It's just a compounding snowball effect.
A very fast snowball, yeah.
And the drivers of this $20 trillion snowball are global smartphone penetration, which loops right back to Apple's sales in China, the rise of digital wallets, and notably, government-led real-time payment initiatives.
Right, governments are pushing this too.
They are. The briefing explicitly names the key players positioned to dominate this space: PayPal, Apple Pay, and Google Pay.
The big three.
Notice that 2 of those 3 are the very companies Greg Abel just moved 30% of Berkshire's portfolio into.
It's a smart money knows.
But this introduces a massive friction point for me. The briefing mentions government-led payment initiative. If sovereign governments all over the world are building their own digital real-time payment rails, aren't they on a direct collision course with corporate giants like Apple and Google?
This raises an important question, right? Because this is arguably the defining economic conflict of the next decade. Gov versus tech. Exactly. Governments and tech companies have fundamentally different incentives when it comes to money. A sovereign government wants money to move instantly and frictionlessly because it stimulates the economy and, frankly, makes taxation easier.
Yeah, they want transparency.
They view digital payment rails like public plumbing. It should just work, and it should essentially be free.
But Apple and Google don't want to be public plumbing.
No, they want to be the toll booth built directly over the plumbing.
Ah.
Governments can build the underlying rails all they want, but tech companies own the physical glass screen that you actually touch.
That's the choke point.
Right. The ultimate prize for Apple isn't the $1,000 you pay for the iPhone. The prize is inserting Apple Pay as the default interface between you and your bank and taking a 0.15% cut of every single coffee, mortgage payment, and grocery bill you pay for the rest of your life.
And that scales to an unfathomable level when you apply it to a nearly $20 trillion market.
Unfathomable.
They are leveraging their hardware dominance, which they secured by deals like the Broadcom blockade, to effectively tax global commerce.
It's brilliant.
It is brilliant, but it also explains why a government might eventually view that as an existential threat to their sovereign control of currency.
I mean, when you control the hardware, the operating system, and the digital wallet, you possess a level of leverage over the consumer that traditional retail banks could never even dream of.
Because they see everything.
You don't just know how much they spend, you know where they are when they spend it, you know what app they were using beforehand, and what AI query led them to make the purchase in the first place.
Which brings our journey today full circle, really. For you listening, let's just quickly connect the dots of everything we've pulled from this briefing.
It's been quite a ride.
It has. We started by looking at a U.S. economy that feels like it's coasting on fumes, cooling job growth, wholesale price drops, exhausted consumers, and it's surrounded by a totally fractured global picture, with China needing stimulus and India fighting massive inflation.
And then, if we connect this to the bigger picture, we explored how institutional investors aren't fleeing the market entirely. They are fleeing to the Magnificent Seven.
Right, the safe havens.
They are treating companies like Apple and Alphabet as historical bargains relative to their massive cash engines, effectively using them as macro shelters from the storm.
We then looked at how Apple is justifying that exact confidence by aggressively securing its moat. I mean, they aren't just competing with NVIDIA on AI.
No, they're playing a different game.
They are using a $30 billion deal with Broadcom to physically buy up the manufacturing capacity, starving competitors, and ensuring their hardware pipeline is completely bulletproof.
All to position themselves for the ultimate endgame, dominating the interface of a $19.86 trillion mobile payments market.
It really reframes how you look at the daily news, doesn't it?
It does.
While traditional economic indicators like wholesale prices and payrolls continue to look sluggish and disjointed, the tech sector isn't just reacting to the economy anymore.
They're beyond that.
Yeah, they are aggressively building and insulating their own massive sub-economy, completely detached from the macro chaos.
They are essentially building the infrastructure for the next era of global finance, and they are doing it entirely within their own walled gardens.
Which leaves me with a final thought for you to mull over as you go about your day. We talked about how these tech giants are essentially building closed-loop economies.
Yeah.
If the mobile payments market is hurtling toward $20 trillion, and a single company controls the AI processing, the physical chip supply chain, the hardware in your pocket, and the payment rails you use to transact, at what point do we stop calling them tech companies and start recognizing them as sovereign digital nations?
It's a profound shift.
It really is. Something for you to think about the next time you tap your phone to buy a coffee.
Indeed.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.